system that just ain't right. Gonna tear it down, gonna start a fight. Anarchy and numbers is my game. I'm the investor with no shame. Greed and corruption, that's the name of the game they play. It's all a shame. I won't play by their rules, I won't comply. Anarchy's the way. It's time to fly.
And here we go. Welcome. I am Matt. This is the Anarchist Investor live on a rare, but not in the future, Sunday at noon Eastern, talking contrarian investments, cash flow, commodities, and crypto. Interestingly enough, usually the parts of everyone's portfolio that they ignore to their detriment. I'm here helping you to grow, invest, and grow your wealth without it getting stolen by some dirty banksters. So it is Sunday. I am usually on Monday through Friday, but as I posted on the Substack last week, I'm actually going to be having some structural changes here in terms of when content comes out. So I will not have the daily live show anymore because I'm getting a job, people. But that's just a kind of personal life moment change that's happening. And so I'm having to change the content calendar, if you will. But there's always going to be stuff coming out every single day that you can consume and take part in and get some good information. So I need you to help out. So with the algo, give me a sub, a thumbs up, a follow, a share, whatever you can do. And so what are we going to be doing in the future? Well, Sunday is going to be a weekly wrap up and look ahead at the week moving forward. And that's going to be essentially the market recap. Some days there will be, some market moving news or something, and I'll do a one-off live or something like that. But you can tune in here or listen or watch every Sunday at noon Eastern, and that's where I'm going to be putting this information out as far as the market recap stuff goes. And if you think about it, actually makes more sense. I'm not a big believer in trading and short-term positions and stuff like that, so it just makes more sense to do a weekly show as opposed to a daily live cast covering price action on things, when I'm not really advocating that people, jump in and do a ton of short-term positions and that kind of thing. So with that, on the live screen or on the share screen, I had Bitcoin because we're going to be doing a Sunday show moving forward here. The Sunday show, the only thing that's really going to be actively moving is going to be crypto, because that is a 24/7, 365 market. And so I will be going through the markets like usual, doing some charting and stuff like that. But from that standpoint, I need to start with a little bit of news here. So I'm going to stop the screen share really quickly. And if you notice, Bitcoin's up a little bit today. It's gravitated a little bit higher yesterday and today. So we'll get back to that in a second. But what I do want to start with is just basically the big news from this past week. All right. And that being said, the biggest news really was the Federal Reserve decision or no decision on Wednesday. And so we're going to dig into that a little bit. This is Yahoo's, weekly kind of recap and look ahead. And I just kind of parse this to see what the corporate media is throwing out there to try and induce people into thinking about the marketplace. Essentially, they remarked it was a good week for stocks because the S&P was up and so was the NASDAQ. But we're going to look at one stock index, which is kind of raising a little bit of an alarm bell here. And if you can imagine, they weren't up. And not to mention the fact that we're going to dig in a second in these, major indexes to show you that all is not well just because they're saying the indexes were up. The inflation reading earlier on in the week came in a little less hot than everyone expected. So there was a lot of celebration in markets because of that. However, if you noticed, it did not induce the Federal Reserve to cut. So Fed cut interest rates the same, or kept the interest rates the same. And everyone's forecast now, they were saying, okay, the beginning of the year, they were going to cut in June. And now they're going to, or actually the most brave prognosticators thought they were going to cut in March or April. They were going to cut in June. Then it was pushed back to July. Then it was pushed back to September. Now we might not get any cuts, or apparently one rate cut. I think that's a load of bull, because I think the economic picture is deteriorating. And I think that's ultimately what's going to force the hand of the Federal Reserve. And you'll see when we look at the fixed income trading, what that's telling us about where interest rates really are going to go. Despite the fact that all these prognosticators are saying, oh yeah, no rate cuts or whatever, fixed income is telling a completely different story. And so the people that are actually putting their money on the line are not thinking that there's only going to be one rate cut or no rate cuts this year. I can tell you that much. Everyone's celebrating. We're going to stick the landing. Yay. Jobless claims aren't that bad. And the unemployment rate has gone up a little bit, but who cares? Things are still all right. And this next week, the biggest thing that's going to happen is Wednesday, markets will be closed for Juneteenth. You can talk about whatever you want as far as that goes, but it's a shortened trading week. So there's only going to be 4 trading weeks this week as far as the Wall Street casino is concerned. And pretty much the biggest information that's going to be coming out during the week will be the retail sales or consumer spending numbers that's coming out. And so there's a big question here on retail sales to see what's going to be happening. I would venture a guess that they're not going to look good at all, because I don't see the consumer just magically finding money just because inflation is moderated, air quotes, a little bit. I don't see the consumer just finding extra cash somewhere to be able to spend. It's just, it does not make any sense, really. And then there's lots of people calling for these bull market tailwinds and that there's going to be this upward thrust. There might be an upward thrust, but I'm telling you, it is not going to be for good reasons. It's going to be because of hopium. It's going to be a lot of retail traders, a lot of FOMO. It's going to be very baseless kind of stuff. It's not going to be based off of economic numbers. It's going to be based off of, continued hopes of the Federal Reserve riding in on its white horse with rate cuts. And there's also a story here with the dollar. I will be writing an article tomorrow for free on the Substack. Every Monday, I will continue to put out free articles on the Substack. And so that's part of the new content calendar. And yeah, the Monday article, I believe I will probably focus it mostly on the dollar, because the Federal Reserve is going to have a dollar problem coming up here. And it has to do with essentially a shortage of dollars. And everyone thinks that U.S. inflation has been what's threatening U.S. dollar dominance throughout the world. I would actually argue it's deflation and a shortage of dollars that is threatening U.S. dollar dominance throughout the world. So you'll have to sign up for the Substack at anarchistinvestor.substack.com to get that article tomorrow for free. I also have paid articles that come out every Tuesday, and I will be starting up the model portfolio this week. I also have 5 ounces of silver that I will be giving away. Originally, I was going to give it away on July 1st because that was the Monday. The June 30th live cast is actually where I'm going to be putting that out. So on June 30th, Sunday, June 30th, on this show, I will be giving away 5 ounces of silver. You have to be subscribed to the Substack to get a shot at that silver. At the very least, some of it will go away will be given away to free subscribers. You get some extra entries if you are a paid subscriber. And in fact, 2 of these ounces will only be drawn out of the paid subscriber listing. So definitely get on board there to get in on that giveaway. All right, what else do I have? One other story to share here. And like I said, we talked about, or I mentioned the, supposedly the corporate investment press, serenading us and telling us amazing things about how the S&P was up and the NASDAQ was up, and we didn't even get a rate cut and we're still rising, and there's these bullish tailwinds, et cetera, et cetera. Well, not all is rosy here, because this is the post out of Zero Hedge. The post caption or just the added verbiage from Zero Hedge is getting stupid. The chart that you're looking at in front of you is a comparison of the S&P 500 index in terms of the weighted average. This is what gets reported in the news. So when the S&P, when they say it's up, 0.5% or whatever, that's the weighted average. And essentially the weighted average is takes the market caps of all of the different stocks, like the prices of them, and it gives the ones that have a higher, like a bigger size, like the mega cap stocks, they get a bigger share of what gets reported as the gain or the loss. Okay. So if the bigger those stocks get, the more they dominate whether or not the gain or the loss is because of their performance. Well, that being said, look at this. Dating back to May 15th, uh, the S&P itself is up just a ridiculous amount, okay? Or not a ridiculous amount. It's up basically 200 points, but that's essentially, 4+%. The equal weighted average hasn't moved. And in fact, it hasn't budged in 4 whole months. Okay. So you're talking about essentially a sideways move dating all the way back to February in the equal weighted average, which means those bigger stocks don't get a bigger percentage. It's just a straightforward, like all of the stocks, what their gain or loss was. And that's what they report in terms of the equal weighted average. So what is this telling you? The outperformance of the weighted average is telling you that just a handful of stocks, okay, mostly tech names like Apple and like Nvidia, are dominating the S&P 500 index. All the rest of those stocks are either languishing behind, like not up very much at all, or even down. Okay. And so that's not indicative of a strong economy. That's not indicative of a strong marketplace, because it can't be a positive that only a handful of companies are doing well and everyone else is struggling. But it's actually kind of an analogy for the economy that we're in right now. If you're an average Joe, the economy is not working for you. You're struggling. At best, you're keeping your head above water, right? It's the wealthiest among us that are having a good go of it right now, because their investments have allowed them to be able, their asset allocation, their investments have allowed them to be able to outpace inflation and continue to profit off of increased prices and things like that. All right. So you have to remember that a lot of this is kind of smoke and mirrors. A lot of this is just kind of shell games to make things look better. I've already addressed in prior live casts how the employment picture is not pretty. And the reason why it's not pretty, despite the fact that they're telling you it's pretty, is because of the way it's reported. There are tons of people that have dropped out of the labor pool, and they're essentially left behind, or they're on some level of government assistance or something like that, or living way, 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 way lower in terms of their standard of living, and it doesn't get recorded. And so we're at, quote unquote, record low unemployment. But if you notice, unemployment's been rising recently. And part of the reason why that rise is happening is because there's a lot of people re-entering the labor pool. And that re-entering effect means that all of the open jobs now have much more competition for people that are trying to get in on, a weekly or a bi-weekly or a monthly paycheck. And, couple that in with the effect of immigration, and some of the assumed effects there are that you have people that are getting paid under the table much lower wages than, someone who is getting paid above the table would be getting paid, and they're holding a job now for someone that's above the table and recorded, but not, doesn't have a job, or is fighting for a job with several other people that are looking to get paid above the table and pay taxes, et cetera, and all the other stuff, right? So the labor market doesn't look great. The economy doesn't look great. We have this very much tale of two cities. This, the wealthy kind of like big mega cap investors, big mega cap companies, they're doing all right because they can pass along inflation, right? The smaller ones, the average size ones, aren't doing that great. Right. And we can actually look at the markets to also reinforce this point. Okay. The S&P and the NASDAQ were up, if you believe the weighted index version of the story. Okay. But what you can also look at is this is the Russell. This is small caps. These are smaller companies. And if you've noticed over the last couple of weeks, they're weak. And if I pan out here over the last few months, actually since June of 22, we essentially moved sideways. There's been a little bit of a, move higher as of late. But again, a lot of that has to do with the Fed stopping rate hikes and potentially starting to cut rates. But you got to remember that this is like a game of chicken that the Fed is playing. The longer they keep the rates higher, the worse and worse the economy gets essentially undermined. And believe it or not, the small cap companies, these are the growth engine of the economy. Okay. If we have such a great economy that, typically a great economy means it's growing. If we have such a great economy, why are small caps languishing? Okay. And keep in mind this chart, this sideways motion in the Russell, and the recent, last couple of weeks, the major indexes are rallying and the small caps can't get going. Okay. Now keep that picture and now look at the S&P. It is a completely different picture. These big mega cap companies have the ability to pass along higher pricing. The smaller cap companies don't. They depend too much on debt. They don't have enough cash flow. They can't price themselves higher because there are larger competitors they're trying to take market share from. And so they can't keep up with what's going on with this handful of large cap companies. And so you notice a huge difference here between the behavior of these two indexes. You can't have a robust bull market without small cap stocks. Okay. And like I said, the game of chicken is how long can the Fed keep interest rates, borrowing rates higher without damaging the underpinnings of the economy? And the growth engine of the economy is small caps. And if their borrowing rates remain higher for longer, they are going to go out of business, which means that now the growth engine of the economy is dead. Well, right now it's dying because there's anyone who has a decent amount of money is not throwing their money into small caps right now. They just aren't, because it's too high risk. Okay. We're also seeing this play out in other areas in the market. Commodities, some have been strong, like gold and silver, and oil has held up well despite its recent weakness. Okay. But a number of other commodities have been getting absolutely annihilated. So there are certain commodities that are growth centric commodities that aren't seeing the love. They're not seeing money pile into them. Meanwhile, there are others that are lower risk. They retain their value if you buy a stake in those commodities. They're holding up. Okay. They're actually getting those money allocations. And so it's very much like the big money investors. It's like a barbell. Okay. They're putting their money into these mega cap, like Nvidia, Apple type names. And then the money they're not putting at risk there is going into super safe stuff. All right. It's going into gold. It's going into silver. It's going into oil a little bit, but not much. And then it's also going into U.S. Treasuries. And we'll look at Treasuries in a minute, but I want to finish my romp here through the casino and look at commodities a little bit. All right. Let's look at the dollar because, like I said, I'm going to be writing this story coming up on Monday. The dollar, if the dollar continues to trend higher, and the reason why it would be is because other central banks are beginning to cut rates. And if the dollar begins to trend higher, this is big trouble because this is a double whammy. If you have higher borrowing costs and dollars are also more difficult to get because there's more demand for them, which drives the relative value of the dollar higher, that means banks are getting hurt. They've been getting hurt all along, but it means banks will continue to get hurt. Regional banks, smaller savings and loans. All right. And then on top of that, you also have these small cap companies that they run on debt. And so it's not just the borrowing cost that's a problem. It's also deflation becomes a major problem for these small cap companies. Because if you think about it, being able to borrow a ton of money at low interest rates perpetually into the future is essentially inflating away your debt. It's what the US government does. Well, those small cap companies try and do that until they get to the point where they can actually be cash flow positive or get bought by a bigger company. Well, if dollars are hard to get a hold of in order to pay your debt and your borrowing costs rise, it becomes this double whammy where small cap companies and smaller, like mom and pop shops, even like Main Street, are just getting annihilated by this economy that they've built here. Okay. So pay attention to this. The dollar here has some very significant levels. If the dollar breaks through like 106.5, so like if you see the dollar printing 107 on the dollar index, the DXY, that essentially means this dollar strength is pushing us not towards disinflation. We're getting to deflation. In fact, there's already deflation happening in a good number of areas within the stock market, or not just the stock market, within the economy, the real economy. I mean, auto dealers can't give pickup trucks away. They can't give them away. They were too expensive for a long period of time. Now they're way expensive. Now there's a huge supply glut because there's tons of pickup trucks that are being repossessed and put back onto the market. And so, some of these dealers have new pickup trucks that were never driven sitting on the lot from like 2022 that haven't been purchased, and they've been sitting there for 2 years. And most of these dealers are paying interest, increasing amounts of interest on what's called their floor plan to have these pickup trucks just sit on their lot and not get purchased. They can't give them away. There's deflation coming, all right? If it's not already here in certain areas of the economy, the dollar increasing in price lends a lot of weight to that deflation. And like I said before, the Federal Reserve's worst case scenario, they keep telling you it's the reignition of inflation. It's a complete lie. Their worst case scenario is deflation. That is because they understand that, how should I put it this way? Monetary inflation versus deflation is very much a momentum kind of thing. And so if you've got the money printer going and you have inflation and it's, quote unquote, under control and it's 1-2% every single year, right? It's really easy to keep that up. Okay. If that stops and all of a sudden you start getting deflation, it becomes very, very difficult to get back to that 1-2% inflation again. It can take a lot of time. It does a lot of damage. Okay. And so mark my words, their fear is not inflation flaring back up again. In fact, in some circles, the theory is that inflation has to flare back up again so that the US government can inflate away all of this debt spending it's done the last couple of years. But that's another economic conversation for another day. The Federal Reserve is deathly afraid of deflation. Keep an eye on the DXY. If this thing starts printing 107 or higher, watch out. They're going to cut rates faster than you can. They'll come back in the middle of their summer vacation to cut rates if the dollar is ripping higher, because they can't afford that. They can't afford deflation. They just cannot. And you'll see them cut very, very quickly and deep when that happens. All right. Let's finish up looking at commodities really quickly. Let's look at gold and silver. Gold, again, pulled back from the highs. This is the weekly chart. It's, you see this kind of consolidation happening. When you see this rip and then the sideways move, this is a consolidation. Some people might call it a bull flag. It's essentially people that rode this wave up. They're taking profit, and then you're waiting to see whether or not that next leg of demand comes in to push higher. I believe it will. It will happen when the Fed cuts rates, and they will have to cut rates. And so gold is kind of marking time. At the end of last week, we picked up a little bit of support here down below in the bottom end of this range. I would expect gold to at least trade sideways, if not slightly higher over the next week or two. All right. Same thing with silver. Silver puts in some more extreme or some higher volatility moves than gold does. But look at this, that line I drew right at like $29, $29.05. Right now it's holding. I would expect silver to continue to try and clunk around here between $30. It might retry it, might pop back through again. It's going to play this song and dance between 29 and $30 until we see what the next move is. Gold will probably precede the move with silver. Okay, so continue to hold on to your gold and silver. I don't advocate people like trade a lot around gold and silver, though I have an interview coming up with someone with Tristan, who's a trader, coming up on Monday. We're going to be talking about trading commodities and crypto and stuff like that. Specifically, platinum should be an interesting conversation about platinum. So definitely keep up your radar for that. You got to be subbed to the video platforms, as well as follow me on X to get that interview when it goes live. It does go live early, by the way. If you are a paid subscriber to the Substack, the video interviews, the full length ones, go live a day earlier. They go live on Tuesday for the paid Substack subscribers. So definitely get in on that if you want to get those interviews early and full length on the Substack. All right. So that's it as really as far as commodity. I'll actually look at uranium really quickly here. Uranium continues to, that's actually the ETF. Uranium continues to have a little bit of weakness here. It's clunking around again after a huge run up. If you didn't check out the interview that I had with Lobo Tigre, he outlines a great thesis for why not only he saw uranium ramping a few years ago, but why he continues to see demand for uranium moving forward. There's all kinds of news flow about countries putting in new nuclear facilities. Okay, so that is going to continue to increase the demand for uranium. I would expect uranium demand to stay high in line with his thesis. So the way I play that is, and I have to hold my nose when I do it, is buying an ETF with the ticker URA. These are uranium miners and distributors, et cetera, et cetera. So definitely a way to take advantage of that trend in uranium. The reason why I focus on cash flow, commodities, and crypto is because crypto is the high risk wild card. Commodities are the way to preserve your wealth against specifically inflation. And then the last piece of it, cash flow, is what keeps money coming in the front door. And it comes along with certain assets like real estate, which are these kind of like safe, steady as it goes type of investments. I think that is a very good, triumvirate of investments. Commodities obviously are a piece of that. And if you've watched this channel at all in the past, or if you're new, I can recap it for you. The ones I really watch are gold, silver, oil, and uranium, maybe even a little bit of copper because of, it being a bellwether of the economy. But yeah, the story for uranium is looking good here into the future. I don't know what the next week is going to tell you, but again, I continue to see really good news flow. And if you've noticed, the URA ETF, despite some of these big drawdowns after these big moves higher, continues to chug along higher. Okay, so keep an eye on that. Again, I advocate value averaging. I'm picking up small pieces along the way on URA, so I'm making that trade along with you. It will show up in the model portfolio on Tuesday. All right, crypto. Oh, actually, before I get to crypto, let's look at fixed income really quickly. Like I said, high yield bonds, man. Look at this. Hold on. Look at this price action. It doesn't show up in the weekly as much, but look at this price action on the daily. Again, we have this downward sloping line of resistance sitting over the top of the HYG ETF, which is high yield corporate debt, aka junk bonds. Again, in line with this narrative having to do with small cap companies that aren't able to thrive in this environment, and it only being good for a handful of them. Well, the ones that are getting hit the hardest are smaller cap ones, the higher risk ones, the ones that have to deal with a lot more debt. Well, if you notice, we got a pop through on this kind of like Federal Reserve rate cut hopium. It popped through and then it rammed it right back down below that resistance line. Okay, so we're continuing to watch this. This is not a valid breakout. Remember, when you're looking at technical analysis on these things to see whether or not it's proving your thesis on the fundamental side, you want to see that break and you want to see come in, revisit that significant level, hold it, and then move higher if you're looking at an upward motion, movement in a particular investment or asset. This didn't give it to you. It gave you a pop through and then it popped right back down again. So we're going to continue to watch this moving forward. Again, this is a leading indicator for risk taking in the market, despite the fact that the S&P and the NASDAQ are up. Okay, like I said, it's only a handful of names. The overall market sentiment for the people that have the Boku bucks, they are not taking a huge amount of risk. Unfortunately, the average person, the average retail trader is right now. And it's evidenced by the rise of just a handful of tech names, some of the rampant speculation that's happening in crypto, the GameStop and, Roaring Kitty business that's happening recently again, 2.0. It's all evidence of a lot of FOMO, a lot of high risk taking, and a lot of what I would consider desperation that's happening in the market. So we'll continue to watch that play out. Now, something that I talked about before is the big money is putting their money to work in some safer things, namely U.S. Treasuries. U.S. Treasuries typically only rally, meaning their price goes up and their yield goes down, which reduces the borrowing cost of the U.S. government. Typically, that only happens in a decreasing rate environment, meaning the Federal Reserve cutting interest rates. Well, look at this. The 2-year interest rate down. People are buying the 2-year. Why is that? Well, whether the Federal Reserve wants to tell you they're going to or not, they're going to have to cut rates. The bond market knows it, and they're front running that move. The 2-year is moving lower. Where the real buying has been happening recently has been in the long end of the curve. So, for instance, if you think the Federal Reserve is going to cut interest rates, you just don't know when. The safer bet is to put your money into the long end of the curve, because those bonds will rally right along with the 2-year as well. But at the same time, you have some safety, because even if the Fed doesn't cut rates this month or next month or the month after, you have years of glide path to expect lower interest rates. And so if it's pretty much a done deal that in 2 to 5 years, interest rates are going to be lower, it's almost a guaranteed bet to buy the US 10-year, because that price of that bond is going to go up and the yield's going to come down over the next 2 to 5 years, right? The 2-year yield might not move just yet. It might take 6 months for the Fed to come to its senses. I don't think it's going to take 6 months. I think September is the latest that they will cut rates. And the bond market is telling you right now, it's screaming, the Fed is going to cut. Over the last couple of months, the 10-year yield has gone from 4.6 to 4.7 all the way down. We're now at 4.225. That's a full interest point lower than where the Fed funds rate is right now. Okay? That is a huge disparity. That's basically telling you that the people with a ton of money, they know what's up. They know the Fed is going to cut. They're putting their money to work in the long end of the curve first, because they have a little bit more cushion, a little more safety there, a little bit more certainty that rates are going to be lower in the future in 5 to 10 years. But once the Fed does cut, watch out. That 2-year yield is going to plummet. But even the 2-year yield right now is more than a half a percentage point lower than the Fed funds rate. And so that means that the fixed income market expects the Fed to cut at least 2 quarter-point cuts within the next 2 years. Okay. And that's a minor cut, especially if the economy goes the way that everyone is feeling it right now, with the exception of a few small groups of people with tons of cash and tons of assets. Okay. Watch this 2-year. It's going to catch up. All right. There is still a huge disparity here. In fact, the inversion between the 2-year yield and the 10-year yield widened even more than it was before. And remember, every single day that inversion exists, banks are bleeding cash, specifically regionals and small savings and loan type shops. Okay. The ones that borrow at the short end and lend at the long end, they are burning money every single day that the inversion remains. And so the Fed eventually has to cut. They have to, because if they don't, everything goes kaboom. All right. And believe me, Jamie Dimon is sitting there hoping that more regional banks go bankrupt, because then he gets to pick them up. He gets to act like a vulture and pick at that corpse for pennies on the dollar. Okay. Believe me, he is all in. Yeah. Keep interest rates higher for longer. Yeah. Good job, Jerome. So yeah, that's the status right there with fixed income. The Fed is playing chicken. They will have to cut. And basically the fixed income market knows that that's going to be the case. All right, let's finish up by looking at crypto here really quickly. Bitcoin today, Ethereum today, up a little bit. It's been up the last couple of days. Okay. And if you notice, it's been weak the last couple of weeks after a decent sized run up. This doesn't mean a whole lot in terms of the trend change at all. We haven't seen anything big just yet. This next week could give you some really important information as far as what the next move is for Bitcoin and then the overall crypto market to follow it. We're at a support level right here for Bitcoin. We are in this triangle right here, this wedge, and the wedge should resolve itself at least by the beginning of July, meaning we only have a couple of weeks. All right. And so right now, this buying pressure that's happening Saturday and today is a result of us being near a significant price level in terms of that 65,000 level that's been support a number of times, as well as resistance a number of times. And then also we're at this upward moving support line, diagonal support line that's sitting underneath the price of Bitcoin. This next week will clue you in on what's going to happen. We're either going to see a significant break lower in Bitcoin, or it's going to continue to just gravitate up this line until we get the beginning of July. And then what'll happen is something. This is what makes people think, but I know, but this was what makes people think that markets are rigged. When these formations show up and then all of a sudden it resolves in July and there's like a big news story that happens right there at the point where it needed to in order to resolve higher, resolve lower, people are like, it's fixed, right? I mean, I know it's fixed regardless. It's just that everyone's kind of watching the same charts and looking at the same price action the same way. And that's why these things happen. But that being said, I fully expect sometime between now and the beginning, say the first week of July, you're going to get some significant news that will probably result in the Federal Reserve giving you either an actual rate cut or a more accelerated viewpoint of when those rate cuts are going to happen, meaning they'll confirm September. They'll confirm the September rate cut. And then if the economy gets worse despite that, or because the economy is just getting worse, the Federal Reserve might even move that timeline up further depending on how bad it is, right? So like between now and say like middle of August, you could end up getting a huge number of regional banks exploding, okay? If that happens, the Federal Reserve will move up that time frame and probably come back from vacation in order to make that rate cut if that's what's happening, okay? They'll have an emergency meeting and announce all kinds of measures and stuff like that. But assuming the wheels stay on the bus, so to speak, you could still see Bitcoin rally as a result of the anticipation of those rate cuts in September or October. Okay, so continue to watch Bitcoin this next week and watch this, level of support that's upward sloping right underneath the price of Bitcoin here. We'll see whether or not we get a break below it, a hold, and then a collapse, or whether or not we actually see the follow through of what looks like this inverted head and shoulders pattern. And if we get that follow through, you'll probably see 80 or 90,000 on Bitcoin pretty quickly, especially if it coincides with some kind of insight from the Federal Reserve that they're cutting interest rates. Okay. Same thing with Ethereum. Now, Ethereum has a slightly different picture, but again, that's because we got this big pop off of the ETF news. Okay. I would expect you're going to get another pop off of the ETF news. It's why I've been value averaging into Ethereum a little bit more than Bitcoin recently, but you're going to end up seeing another pop in Ethereum, especially if Bitcoin takes off, right? If Bitcoin takes off, everything's going to follow it. There'll just be a ton of fast money that will, then find its way back into crypto again in order to chase that tide higher, okay? A lot of the other cryptos, for the most part, they've actually traded lower recently, and they haven't been nearly as strong as, say, Bitcoin and Ethereum and held up that way. A lot of people are expecting that this is going to be an opportunity to load up if you are a trader. Again, I don't advocate trading. I want more long-term positions. But if you are a trader, a lot of them are looking at this as an opportunity to load up in some of these smaller cap cryptos. Bitcoin Cash, Solana, Avalanche, okay? Expecting that when Bitcoin has that moment, it pops through, a couple of days to a week later, you're going to see the follow through in all these, altcoins, these mid cap coins and things like that. They're going to move higher. The last thing I'm going to close on, I'm going to look at Hive really quickly, because this is kind of like my darling kind of crypto that I love, just because I love the platform. I love the decentralization. It is at a pretty nice level for me to actively start picking it up. Okay. Now you have to understand, I earn Hive by posting on the blockchain and getting upvotes and things like that. So I earn passive crypto income on the Hive blockchain by doing that. This is a point here where I'm taking my stable coin that's on the Hive blockchain, converting it to Hive, to the native crypto. And then on top of that, I'm also starting to put additional cash into the Hive ecosystem to purchase Hive, even if it goes below this 25-cent level. If it gets below that 25-cent level, I can even go back here and I can look at some longer term trends, and I'm buying all the way down to, 10, 15 cents. Okay. Granted, that is a huge percentage drop, but I have full faith that this project long term, like not just a year, not just 2 years, like 10, 20 years out into the future, this project is going to be a player, and it's going to have a significant amount of value built up within this native crypto. And so anytime I get the opportunity to buy this thing on the cheap, that's what I'm looking to do. If it breaks through 25, I'm putting money to work to actually buy more, as opposed to just reallocate the funds that I have in that ecosystem to kind of like arbitrage the price between the stable coin and the native crypto. I'm actually putting cash into the Hive ecosystem to purchase Hive crypto. So that's all I have. That is the first Sunday market recap and look forward here for the Anarchist Investor Live. A reminder, I will be back here again next Sunday at 12 Eastern, not the Monday through Friday that you may be used to. So you definitely have to be subscribed to get notifications, and help me out with a little bit of thumbs up on the algo, and it'll help share it with a bunch of people that are out there. And yeah, another reminder, sub to the Substack so you get in on a drawing for some free actual money, the people's money, some silver, right? This is like $150 right here of silver, 5 ounces of silver. Who would have thought? Actually, a lot of people who follow finance would have thought, unless they were Keynesians. But that being said, I will be back here next Sunday. I appreciate every single one of you for sticking with me. Let me give you a little bit of a preview as far as the content calendar moving forward here before I say goodbye. So yeah, Mondays I will have the free article out on the Substack that goes out to all subscribers on the Substack, free and paid. On Tuesdays, I will be doing what do I have on Tuesday? Oh yeah. Tuesday is the early release of the weekly interview, and so like the Wednesday night will be the main release night for the full-length interview. But on Tuesday at 6 p.m., if you're a paid subscriber, you get early access to that full-length interview on the Substack. What else? Wednesdays, I will have what the heck do I have going on Wednesdays? This is like, we're off to a great stop right here. Wednesdays, I'll probably have some snippets that I'm putting out in terms of the interviews, as well as some other content. Could also be an opportunity for, a midweek live cast to kind of poke my head in and say hi and check in on things. But I'll have a couple of snippets of the full-length interviews and past interviews as well coming out probably Wednesdays, also on Mondays and Fridays in the evening. Those will hit. And then and Wednesday is the full-length interview that comes out as well on the main channels and for free everywhere. And then Thursdays, I will have a paid newsletter that will go out. That'll basically be the portfolio update and recap and a couple of other things, maybe some insider market insights, that kind of thing, as far as the paid subscribers go on the Substack. So really, and then I'll have a monthly update on the model portfolio for all the paid Substack members, and then a monthly giveaway as usual for all the subs over at the Substack. So yeah, that's really what I'm working on right now. I am super happy that this went off well. No technical issues, which is fantastic. And if you don't follow, I also do another podcast at night on Sundays with my wife called Ungovernable. If you don't follow the Ungovernable page over on Facebook, I believe it's Ungovernable Pod. But also if you go into YouTube or Rumble, you could find Ungovernable Pod on there. Tonight we have an interview with an awesome dude. Mark Hughes is like he's into ghosts, he's into UFOs, he's into conspiracy theories, Bigfoot, all kinds of stuff, like, interdimensional conversation and portals and all kinds of awesome stuff. We're going to be talking up Mark tonight. It happens tonight at 7 p.m. Eastern. So if you're around, definitely check that out. It's going to be a good time. Me and Jocelyn crack a bottle of wine, and we have some awesome conversations with people about some things that you hardly ever hear about, or maybe you haven't heard, some of these people's opinions or actual research and takes on these topics. So it should be super fun. All right. With that, I want to thank all of you to making it to this point in the broadcast, and I will see you again next Sunday at 12 Eastern. With that, appreciate you. Love you. Peace.
Stuck in a system that just ain't right. Gonna take